ICAI students, let's revise CA final AFM Advanced Capital Budgeting Decision. Practical question 20. A firm has an investment proposal requiring an outlay of 80,000. The investment proposal is expected to have 2 years economic life with no salvage value. In year 1, there is a 40% probability that cash inflow after tax will be 50,000 and 60% probability that cash inflow after tax will be 60,000. The probability assigned to cash inflow after tax for the year 2 is as follows. In year 2, if the 50,000 probability of 40% happen, then again in year 2 it will get split into 3, where 24,000, 32,000 and 44,000. And if in case that 60% probability of 60,000 inflow happens, then the probabilities are 40,000, 50,000 and 60,000. The firm uses a 10% discount rate for this type of investment, and the requirements are: we have to construct a decision tree for the proposed investment project and calculate NPV. Then the second requirement is, what NPV will the project yield if worst outcome is realized? What is the probability of occurrence of this NPV? So based on the decision tree, then we have to find out the worst case, and the third requirement is best case, and what is the probability of that worst case and best case. And finally, we have to decide whether the project should be accepted or not. Going to the solution. So first we have to construct a decision tree like this. So the first decision is the cash outflow of 80,000. Then from there are two possibilities. Either 50,000 cash inflow will happen at year 1. So here this is year 1 and this is year 2. So year 1 has two possibilities of 50,000 and 60,000 cash inflow, wherein for 50,000 40% probability, for 60,000 60% probability. Then again the branch differs. For second year, if 50,000 happened, then there are three possibilities of 24, 32 and 44. Then if 60,000 happened, then there are three possibilities. Now based on this decision tree, we have to find out the NPV. But now as we can see, there are 6 results for the same project. So we will get 6 NPVs also. So there are 6 outcomes, but each outcome has a different probabilities as it becomes a joint probability. So we have to find out this joint probability. How we will find out? Year 1 and year 2 probabilities, if we multiply, then we'll get the joint probability of this outcome. Now after getting this joint probability, then we will find out NPV. As we have seen, there are 6 outcomes. NPV also, we will get 6 NPVs. Now the first year cash flows will be multiplied with the discount rates. Same case goes with the year 2 also. And out of the 6 NPVs, now we have to see the best case and worst case NPVs, as it is the requirement of second and third. Now they have given statement showing expected net NPV, which is nothing but they have taken the NPVs, then the joint probability of happening of these events, then expected NPV. So if we multiply all the NPVs with the respective joint probability, then the total of this NPV will be the expected NPV, which is coming as positive. Thus the project can be accepted on an overall basis. Now the worst outcome of the project, and the worst outcome out of this decisions will be this negative 14,000, which will be having a probability of 8%. And if it happened, then the loss would be negative 1,178. And for the best outcome, the NPV will be 24,100, and the probability of happening is 6%. If it happened, then the expected NPV will be 1,446. Now, will the project be accepted? The project should be accepted because the expected NPV on an overall basis is positive based on the joint probability. Thus, the project can be accepted. Thank you.